Today on Your Money, Your Wealth podcast number 357, the 5-year rules for Roth withdrawals. Does that 5-year clock start with every Roth conversion? Plus, a Social Security Medicare IRMA retirement spitball, a self-employed retirement savings and tax planning spitball, and Delaware statutory trusts, security-based loans, charitable remainder trusts, and other charitable giving strategies explained. Also, will your portfolio grow faster with the help of a financial advisor? And if you've got a smoking hot wife 8 years your junior and you want to retire on the same day at ages 70 and 62, are there other financial considerations or are you just bragging? I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
Let's see. We got, hi, Joe and Big Al. I just discovered your podcast, and it's very informative. I have a question for you about Roth conversions. Okay. 66, retired in 2021. I have about $2 million in tax-deferred IRAs, 401ks, and $50,000 in a Roth IRA. Also, I have about $190 after-tax cash reserves that I'm planning to use to supplement my Social Security benefits to cover my living expenses until age 72. Beginning 2022, I'll start Roth conversions of about $100,000 each to keep within the Medicare IRMA limit in the 24% tax bracket. So IRMA, God, we got some
We do. They're on top of it.
I mean, get a life, people.
What does that stand for? I know it's Medicare, but what does that stand for?
Income-related monthly adjustment amount.
Yes.
IRMAA.
Yeah, adjustment amount.
Adjustment amount. Because what happens when you have too much income?
Yeah.
Right. They're going to increase your Medicare premium.
Yeah. And it's a 2-year look back. So if you have more income this year, in 2 years from now, your Medicare premium is going to be higher.
Super smart people. Then I'll take the minimum distributions from the tax deferred assets. Okay. I get your plan.
Yep.
So she's going to defer her retirement account. She's going to live off of cash. She's going to do Roth conversions.
Yep.
And then she's going to take RMDs at 72.
Perfect. Like it.
All right. So I started Medicare Part B and Social Security benefits of May. I'm single and I am on widow spousal benefits until age 70, when I'll take my larger benefits. I was planning on converting the annual $100,000 from my traditional IRAs and putting in $75,000 to the Roth IRA so the brokerage house can remit my estimated taxes of $25,000 to the IRS. The rationale is that I don't want to spend my cash reserves when I'll need it to live off of until I'm age 72. It's my understanding that the 5-year rule still applies for each Roth conversion. Is that correct? I know you don't advise people to contribute net of tax to Roth, but if I pay taxes out of my living expenses fund, I'll need to withdraw money from my Roth and then pay taxes on their earnings. What's wrong with my thinking? Thanks. You guys are great. Donna. All right, Donna, very, very good job. She gets her facts straight. I like what she's doing. She's got a really well thought out strategy and plan. And is there anything wrong with her thinking?
There's nothing wrong, but I would do it a little differently.
Okay.
Here's what I would do, Donna. I would actually put the whole $100,000 into the Roth and then pay the tax out of your 190,000 cash. And eventually when that ran out, then
do less conversion.
But if you front load it, you're going to get more in the Roth sooner and have that much more tax-free growth.
So don't take the money out of the Roth when you have to do extra distributions, right? So convert, I agree with you 1,000%. Do the full 100,000 or, up to your IRMA limit that you feel comfortable with.
Right.
But I would also suggest that she's single. She's got $2 million. I'm not sure what her Social Security is going to be, but she's switching to a larger benefit at age 70 than age 72. If she's not going to get married, the top of the 22%, let's see, tax bracket is what? $40,000. You're in the 22 as a single taxpayer.
Yeah.
86,000.
Go to the top of the 24.
24 is 164.
Yep.
Her RMD and Social Security could be 164.
Could be. Yep.
Right. So you might want to convert to the top of the 24% tax bracket and get all of that money out and put it into a Roth. And then you're going to spend down the cash reserves anyway, right?
Right.
it's not like you're running out of money.
Yeah, you got
You
plenty of
got
money.
plenty of cash,
Right.
but it's just going to be taxable. And so instead of converting to the top of the 24% tax bracket or whatever number that you figure out or whatever IRMA limit that you want to go to, right, you're just going to convert less and take more out of the retirement account to live off
Yeah, when you're done with your other cash.
when the cash is
So,
gone.
so another way to say this is that if you go over the IRMA limit, yes, you're going to pay more in Medicare expenses for Medicare insurance. However, just consider that an extra tax. And if it still makes sense, then go ahead and do it.
Right. Yeah. You just add in the added cost to
what the tax is and see if it still makes sense.
And I believe it probably would for her.
Probably, given that she's got so much money in the regular, the $2 million in tax deferred.
Right. So she's got a good problem to have here.
Great problem.
And I like her way of thinking, but if she would fine tune this just a little bit, she might be tripping. And no offense to Donna here, but I think people do this sometimes, is that they might trip over, what's that saying? Trip over dollars to pick up quarters.
Other
Is
way
that
around. Or-
Trip over.
No, I think it's trip over dollars to pick up pennies.
Oh, yeah.
Isn't
Yeah,
it?
You're right.
No, it's pennies, but
You're
I
right.
said quarters because it's. I don't want to be that rude. I already get enough hate mail.
You've never got any, have you?
Yeah, the Ninja Joe. thinks
Well,
I should retire.
Real life ninja, yes.
So with this whole IRMA thing,
Yeah.
is that I'm going to pay a little bit extra in Medicare premium. So I want to be very
That's right.
careful of that. But then they're going to end up paying a lot more in tax on the distributions of their RMD.
Said another way. So you pay a little bit more Medicare and premiums to save a lot more tax later.
Yes.
Potentially.
So you just have to run the numbers. And I think she's looking at it right, but fine tune this thing, and then she might make different decisions.
Yep. I agree with that point too.
Okay. I have owned a Roth IRA for many years. Therefore, I'm able to withdraw tax-free. Now that I'm retired and want to do Roth conversions, does the 5-year clock start with each conversion I do after the year I converted? Bill from Carmel Valley.
Well, I'm going to do the simple answer. Bill, if you're 59 and a half or older, it does not apply.
Correct.
But it's much more complicated if you're under 59 and a half.
So the reason why the 5-year clock exists on each conversion that is done, right, is that people used to convert monies from IRAs to Roth IRAs. And then the next year they would pull the money out and avoid the 10% penalty.
Right.
They pay their tax. It's in a Roth. It's after-tax dollars. You always have access to the after-tax dollars in a Roth IRA. It's FIFO tax treatment. So it was a workaround that people could say, all right, well, I converted this. I paid the tax. Now I'm going to take the money out and avoid the 10% early withdrawal penalty.
Yeah, I bet you some did it same day.
I'm sure they did.
Yep.
Same,
Oh, look at
same,
that. I avoided the penalty.
same transaction.
Yeah, right.
Convert, then let's withdraw
And send me the money.
and then spend. So here's so they came, any type of issue like this, they catch on after a few
Yeah,
years.
right.
And they were like, you know what, no more. So if you do a conversion, and if you're under the age of 59 and a half, because the 10% penalty only applies to those that are under 10 or under 59 and a half. So if you do a conversion under 59 and a half, you have to wait 5 years or 59 and a half, basically, in whichever's later, to get access to the principal of those dollars tax-free.
Whichever sooner, right?
Whichever sooner.
You said later.
Whichever sooner.
Okay.
So if you're doing a conversion after 59 and a half, the 5-year clock doesn't apply unless you don't have any other Roth IRAs,
Oh, boy.
because the other 5-year clock will come into play. So,
There we go.
so
This is where it gets complicated.
because there's a 5-year clock to get access to the tax-free money. And so, there's rules that need to apply for it to be a qualified distribution tax-free. And one of those rules is that there's a seasoning. The money needs to be in a Roth IRA for 5 years for that money to come out tax-free. And you have to be over the age of 59 and a half.
Right.
However, you can take money from a Roth IRA under the age of 59 and a half tax-free if you take your principal out.
Yeah. And skip the earnings.
It skipped the earnings. You're
Yeah.
saying, I'm not taking the earnings. I'm going to just take my principal, because it's 4-tiered in the damn Roth
It's-
IRA of
it-
how the money comes out and how it's taxed.
As long as it's 5 years after the conversion. Or you can do contribution next day.
Right, because here's how it's 4 tiers. It's the first thing that comes out is contributions, and then conversions, and then earnings on contributions, and then earnings on conversions. But then it depends on your age, right? So then they look. I mean, is this complicated
So
or what?
let me simplify. So Bill, if you're 59 and a half, you don't have to worry about the 5-year clock on each conversion. You do have to still wait 5 years from your first Roth to pull out the earnings.
So if you don't have a Roth IRA and you just started doing a conversion, then you have to wait. But Bill, he says, I've been having Roths for years.
Yeah, right, exactly. So yeah, I think you're good, Bill, as long as you're over 59 and a half.
Yeah, so that's a key factor. I just wanted to share my knowledge. Just wanted to show off my 5-year clock knowledge.
And I should mention the fact that we actually do have a white paper on the topic so that you can actually have a physical copy of the rules in front of you so that you don't have to try and make sense of everything that Joe and Al just said.
Still doesn't make any sense. It's way too complicated.
All right.
Download that guide and sharpen your knowledge on the rules for withdrawing from your Roth in the podcast show notes at yourmoneyyourwealth.com. Listen to YMYW episodes 255 and 265, both on that 5-year Roth clock, and download our free guide dedicated to the 5-year rules for Roth IRA withdrawals. It's an in-depth breakdown on how and when you can pull money out of your Roth IRA based on whether you're over or under age 59 and a half. Click the link in the description of today's episode in your podcast app to go to the show notes and download the 5-year rules for Roth withdrawals. For more in-depth personalized help, click the big green Get an Assessment button at the top of the page and schedule a free financial assessment. Stress test your portfolio, find out where you might be able to save more on taxes, and get a plan tailored to your specific risk tolerance, goals, and circumstances. Do it all at yourmoneyyourwealth.com.
Good buddy Batman, he writes in, hello to Andy the Angel, Big Al, and Mighty Joe Young. I hope all is well with each of you and your families. I must begin by thanking each of you for consistently presenting such an entertaining, intelligent, and extremely informative podcast. I have no pets as my schedule does not permit it. I have no limerick for you, though I would prefer you to Jack Napier.
Refer.
Who?
Wait,
refer.
You said prefer.
Oh, prefer. Refer.
Refer you.
To refer you to Jack Napier and or Edward Nigma for that.
Okay, we better get right on that.
Is that like a Batman reference?
That's
I'm not really even sure.
Edward Nigma, isn't that the Riddler?
I don't know.
I believe it is.
You know what? I think you may be right.
Yes.
Enigma. Yeah, that makes sense.
Yep. I still drive the 67 Batmobile. I have 4 subjects that I would like information on. I hope you're able to go over them at some length, as I believe many of your listeners will benefit from the information. The first is Delaware statutory trusts. Do you like them as a solid option in which to do a 1031 exchange? If so, any particular companies you would recommend? Also, if someone 1031s into a DST, which are in multiple states, does the owner have to file a tax return in each of those respective states? Naturally, I'm omitting the states with no income tax. Okay, so let's unravel this.
Yeah. So a Delaware statutory trust. So that's kind of like the old tenant in common with a new wrapper. So the old tenant in common, this was 2004, 5, 6, 7, 8, 9, 10. It was a decent concept, which was instead of buying one property, you buy a small interest in an entity that owns lots of properties. So you spread your risk. The problem with the tenant commons, and I think with some of the Delaware statutory trusts, is the cost, the internal costs. And so basically what you're doing is you're no longer managing the property yourselves.
Let's back up a little bit here too, though, because what a 1031 exchange, I mean, most people don't even know what that is. So let's say you have a property that is appreciated quite a bit. You don't want to sell it to pay the tax. So there's multiple ways that you can avoid the tax or reduce the tax.
Sure.
And one of them is to defer the gain of that property to do a like kind exchange.
Yeah, that's right. And so you can buy another property, similar property. You can buy 2 or 3 properties, or you could buy into an entity that has several properties. Yeah, that's a good framing.
So a DST, or Delaware Statutory Trust, was something easy that instead of finding a property, right, getting a realtor or going out there and saying, hey, I have this commercial building or apartment building or even a rental house, that I have to find a like property
Right.
that I can exchange into. So it has to be, you have to identify the property in so many days and you got to close in so many days. So there's time limits for people to do this 1031 exchange.
Right.
And they can identify a few different properties, and if it blows up and then they have to pay the tax, or they can do a reverse exchange. It gets fairly complicated.
Right.
So they could go and do a tenant in common, which you were just referencing,
Yes.
which is now you are investing in a pool with a lot of other investors.
Sure.
A Delaware statutory trust came about, a DST, that made it a little bit more convenient. You couldn't find a like property. You wanted more cash flow. You didn't want to manage the property. So you would exchange into this Delaware statutory trust that was more of a diversified basket of real hard assets.
Yeah. So to just point the differences. So a tenant in common was actually generally one property that you own a small piece of interest in. Delaware statutory trust, it would be a trust that owns several properties. So you get more diversification. I'm fine with the concept. Here's what I'm not as excited about is, one, you give up management responsibilities. So you have no way to improve the cash flow or the value of the property. You also have no say in when it gets sold and all these types of things.
You lose control.
You lose control. And to me, maybe even the most important thing is they tend to have pretty high internal fees. So in other words, you're not getting 100% of the cash flow that you would otherwise get. You have to give them their cut. And it makes sense, right? Because they're finding the properties, they're managing, they're fixing them up, all that sort of stuff. What happened in the Great Recession, I'm not saying it's going to happen again, but it sure did back then. The properties went down in value so much, and the debt was greater than could be serviced by the tenants. And a lot of these were lost in foreclosure. And so people that put money into tenant commons, some, not all, some lost everything, right? Because they got nothing back from it because it went back to the bank and it paid off the mortgage on that property. So, but when you look at these kinds of things, well, I think one of your questions, a couple of big questions is, do you like the investments in there? Number one, would you rather have apartments, residential, which tend to be a little bit safer? Would you rather do commercial, which can be a little bit greater return, but maybe not as safe? That's number one. Number two is, what's the cost structure? What are the general partners? What are they getting out of this? And I had a third one that I totally forgot. I'll think of it in a second.
Well, I mean, I think we're not going to give you any recommendations
No.
on, what Delaware statutory trust. It's like a mutual fund in a sense. I mean, in real simple forms, it's not, hey, buy this mutual fund. I mean, if you have a hard asset that you're trying to avoid taxes and you want to do a 1031 exchange and you want to lose control and you want to have free cash flow, in not necessarily deal with the hassles, I think they're great investments.
Yeah.
But it's not appropriate for everyone. You just have to do your due diligence, just like with any other investment that you choose.
Yeah. And it's kind of like, even with tenant commons or anything like that, look at the properties carefully. Are these properties that you want to own? Maybe they are, maybe they're not. So treat it as if it were your own investment. As far as taxes, yes, if they have properties in several states, you're going to be doing filing tax returns in several different states. So just be aware of that.
All right. Second question. He's got security-based loans. I wonder if you wouldn't mind expanding on exactly what they are, how they work, potential negatives, and some positives.
What do you got?
I have got nothing.
Well, I think a security-based loan is similar, but maybe not this exact same as a margin loan.
I don't know.
That's I actually did take a look at that, and I'm not an expert at it, but it's another way to get cash from your brokerage to use for other purposes besides like buying more stock and things like that.
You're just pledging your assets for a loan
are.
at a pretty lower rate.
You are, and of course, I believe, don't quote me on this, I believe it's got the same risk that a margin loan has, which is if the stock market goes down low enough, you get a call on the loan, you have to pay the loan, and you don't have enough value in your stocks. So just be careful.
The third is charitable remainder trust. Again, please, all caps, expand what they are, how they work, the pros and cons of this product. Also, do you like them better or worse than a 1031 into a Delaware statutory trust? All caps. I understand each circumstance is unique. Perhaps you could explain where one would be more beneficial than the other. All right. A charitable remainder trust is not a product.
Correct.
It is a trust.
Yeah, it's a trust that you hire an attorney to set up.
Yes.
You're in control.
What you do, what the pros and cons of a charitable remainder trust, or what we call them as a tax exempt trust as well, is that, so you have this property. So hypothetical, Batman is selling the Batcave, right? So he bought it for $100,000. It's worth $1 million.
Sure.
And he's got $900,000 of gain. He doesn't want to pay the tax.
He wants to sell it, but he doesn't want to pay the tax.
He doesn't want to pay the tax because
And
he's cheap.
And he doesn't want to do a 1031 exchange because he doesn't want any more property.
So he's like, okay, I could do this Delaware statutory trust,
Yep.
and then I could get some cash flow from that. That's
Sure.
fine. I avoid the tax. All $1 million goes into the DST.
Yep.
Right. So you avoid the tax and you defer the tax to a later date once you sell onto the DST. Or he could put the money into a charitable remainder trust. So basically, the trust then sells the property. Because it's a charitable remainder trust, it's a tax exempt entity, and there's no tax due on the sale of the property.
So the whole $1 million is there and available.
It's sitting in trust.
Yeah, right.
And then you can diversify. You can buy stocks, bonds, mutual funds. Then that's when you get into the product. The trust itself is not a product, it's an entity. And then you put the property in, you sell the property, then you purchase product. You could buy CDs, cash, mutual funds, ETFs, individual stocks, anything that you want, and you can have a globally diversified portfolio. From there, you can take income from the trust, but you have to set up what that income looks like prior to setting up the trust. So you could say, hey, I want a certain percentage that comes out. Or I want to have a remainder that goes to a qualifying charity at my passing or at my wife's passing or at a certain time frame. So charitable and remainder trust, all that means is that the remainder balance of that trust will go to a qualifying charity at your passing. So you can utilize the trust as you're alive. You can create cash flow. You avoid the capital gains tax on that asset. You get higher cash flow. You're taking principal back. That is going to be taxed basically on how the investment is taxed. So it could be capital gains, could be ordinary income. You're also going to pay the capital gains tax throughout the distribution.
Right.
So there's pros and cons to each.
Yeah. And so here's typically what we see from clients that we talk to. They want to do an optimizing charitable remainder trust, which means they want maximum cash flow to them and minimum to charity. And minimum to charity means 10%. So 10% of $1 million, the plan would be $100,000 would go to charity at your passing, plus inflation. So it's a little different number, but you get the idea. So 900,000 of value comes out to you over your lifetime, and charity gets 10,000, that or 100,000. That's what makes this tax exempt. And if it generally it's through your lifetime, or if you have a spouse, it's second joint life. And if you guys, you're single or married, if you live a long life, you'll win. If you die a week later from a car accident, well, you lost, because whatever's in the trust when you die goes to charity.
Right.
So where we see this effective is, first of all, people that have highly appreciated real estate or highly appreciated stock, they want to sell, but they don't want to pay the tax. They'd like to get a cash flow. Maybe they don't have beneficiaries. They don't really care. We have some clients that don't have kids. They don't really care that much. Or if you do have beneficiaries, we still see some clients, if they really want the kids to get some of the assets, they buy a term life insurance policy to help cover that in event they pass away early.
So pros and cons to each. Another quick thing, and you might have mentioned this, but I wasn't listening. If Batman puts the $1 million property in, sells it, and optimizes it, he gets $100,000 tax deduction in the year that it goes into the trust.
I did not mention that. Good point. So, and if you want a higher tax deduction, then you don't optimize, you get a lower payout. And that payout is calculated before the trust is set up based upon your age. It's actuarial calculation. And the design is that if you lived a normal life expectancy, you will get 90% back. That's the idea, or whatever percentage you decide to give to charity.
So I think that's pretty good detail for that. So,
yeah.
Okay. How about Rich? First off, you guys are great. Love the banter, and your show is very informative. I have a SD, self-directed.
Ooh.
Got these guys with their acronyms. I got an SD.
That's good.
R401k.
I'm thinking San Diego Roth.
I know.
South Dakota Roth.
I thought too at first. San Diego. So you got a Roth 401k in San Diego.
You did San Diego. That's important info.
I have an SD Roth 401k that I max with additional ND mega backdoor Roth.
Non-deductible.
Non-deductible. Even I knew that one.
We got San Diego, North Dakota, out back in backdoor.
Yeah,
Or
I
North.
know.
South Dakota and
That's
North
right.
Dakota.
Uh,
I did the 401, the Roth in South Dakota, did the other one in North
North
Dakota.
Dakota. Okay, so I'm just reading how this guy's writing here, folks.
right.
First off, you guys are great. I wanted to say that again.
Yeah.
I love the banter in your show. Is very informative. I have a SD Roth 401k that I max with additional ND Mega Backdoor Roth. This last year, I added a defined benefit plan, BC. My side hustle made a lot of money. I expect to make 3 or 4x this amount for the next 2 years. I read about adding a non-qualified deferred compensation plan to mitigate taxes. Can I do this? If so, what steps do I need to take to do this? Do I need a custodian to handle this? I read that I could do a SERP as I am the CEO and have no employees. Also, I plan on selling this business and looking for ways to shield capital gains. Besides investing the capital gains into an opportunity zone fund, are there any ways to mitigate the taxes? IRS rules say I cannot put the company shares into my Roth. Can Delaware statutory trust be utilized? Thank you for your replies. And I drive a 2015 Jeep and I have no debt. Wow, he's throwing out a lot of stuff.
Yeah,
He's got
right.
Delaware statutory trust. He's got SERPs.
We
He's
got a
got
lot
the
packed in there. sir.
SARSEP. These are a little bit older plans. All right, so he's got a solo 401k,
Yep.
and he's doing after-tax contributions as the employer and employee. So
Sure.
he's maxing that out to $54,000 to some odd $1,000, and he's converting the non-deductible contributions into the Roth.
Yep.
And then he's making the 401k contribution as well as Roth. So he's got this side hustle and he's thinking about, hey, can I do something else? Is there anything else that I can do? He can set up a DB plan. So that's a defined benefit plan that he could shelter more dollars in pre-tax. And if he sells the business, he's going opportunity zones. He's already maxing out a 401k plan. He's doing after-tax contributions with the Mega Door, Mega Backdoor, or Megatron Roth. And now, because he's got this little side hustle, he's going to make 3 or 4 times this money in the next couple of years.
Right.
So he's thinking about, all right, well, where can I shelter some of this money?
Yeah, I don't want to pay all the tax.
I don't want to pay on the
And
tax.
That's a very fair question.
So the only question, I mean, there's a few questions that I have, is that he already has a solo 401k plan. Does he have 2 side hustles?
Yeah.
You know what I mean? Is like,
Yeah.
does he have one company that's doing X and then he's got another company that's doing Y?
I'm not clear on that either, but I guess, I mean, whether he has 1 or 2, maybe it doesn't matter because they're probably solo.
Right.
I guess.
So he can't necessarily, if let's say I have 3 different companies, I can't set up 3. I mean, I guess I can set up 3 401ks, but I can't max all 3 of them out.
Correct. And when you have, when it's similar ownership, it's treated as one company. So you kind of have to look at it as one company. If there's in fact more than one company, you can do you can do a 401k, you can do a SEP IRA, you can do a defined benefit plan. Those are the types of things that are available. Defined benefit plan, you can actually put a lot away, but you have to commit to making a similar contribution for
At least 5 years.
at least 5 years, probably longer. A deferred compensation plan does not work in a solo business. And what they are is where an employee says to the employer, I want you to withhold some of my salary so I don't have to pay taxes on it. So then the company doesn't have to pay that salary. The company has higher profits. It pays taxes on those higher profits, but you don't. Now, if it's your own company, you're going to pay taxes on those profits. So I've never seen, and I can't think of any reason why you'd have a deferred compensation plan in a solo owned business.
Unless it's one of those, I remember those plans back in the day, the
412.
412Is
or whatever.
Yes,
Yeah.
the 412I
Did-
funded with life insurance.
Did they get outlawed?
Well, I'm sure someone's out there selling them.
Probably.
So there's when the 412Is and there was another one, 419 plans or
Yeah.
right. So there are some of these plans that come about there's the people target, self-employed individuals that make high income to shelter taxes. I would be very, very careful with those types of plans. Some of them work, some of them don't. Some of them are pretty gray with the letter of the law. Some of them are right on. So I would be careful. We like to keep things somewhat simple, right? We're pretty conservative in regards to our tax strategies. So there are some other types of plans that we have seen come across our desk in, the several years that we've been doing this. But we would not necessarily recommend those. So when you're thinking about selling your business, what do you think? Should they go in an opportunity zone?
No, unless you want that as an investment. I mean, basically the opportunity zone defers taxes for
A couple of years.
few years, right? And then you've got to pay all those taxes, even though you still have the asset. It's not like a 1031 exchange where it defers it until you sell. Now you do get any future increase in that opportunity zone asset is potentially tax-free as long as you own it for long enough. No, I'm not a big fan of those. I think it was an interesting idea that came out, and I think people did well that got into it early. Now many opportunity zones are so overpriced because of this tax benefit that I'm not sure the investments are that great. That's my perception.
Sure.
I could be totally wrong, but no, I would not do that.
Because an opportunity zone is that you're investing in an area that has an opportunity for growth, right? You're trying to make an area better, right? You're putting investment into an area of a city or something that can grow it and make it
better.
Yes, I was going to say another word, but I think I'm just going to keep it like that. But right, a lot of money is got into these investments. And
Yeah, I mean, I personally, I heard like 3 or 4 years ago that it may be too late because these areas are much higher priced now. I wouldn't do that. A couple thoughts is if you do sell a business, capital gains not that bad. And if you really want to save money, move your business to Nevada or Texas or a state that doesn't have any income tax, and then sell it and you only pay federal tax.
That's it's pretty aggressive.
As long as you move. Don't fake it. I mean, you really got to want it.
Yeah.
And plus
you're moving.
And this is not move 6 months, sell it and come back. This is
Oh, really? Do you know anyone that's done that?
yes. Generally doesn't work. No, this is a 5 or 10 year plan. 5 years at least, but that's one way to go. If it's a S corporation or an LLC, well, not an S corporation, that doesn't work. But if it's an LLC, you could potentially put that into a charitable remainder trust. S corporation, charitable trust is a prohibited owner, so you cannot do that. But an LLC, you can. So that would be another way. Set up a charitable remainder trust, and you sell the business, pay no tax, and get a cash flow for life. So that could be something.
So, Rich, congratulations. It sounds like you're doing a hell of a job. Your side hustle's killing it. You're making a lot of money.
Yeah.
So very good there. And you're looking at other ways to save money, which is great. You know what? Just probably talk to a really good tax accountant, in your area to look at, things that are above board. I wouldn't necessarily go to an insurance agent if someone's giving you
what the plan should be.
what the tax strategy should be. So
yeah, and I would say, unfortunately, a lot of CPAs aren't really even aware of these strategies that we even just brought up.
'Tis the season to give and get back. Learn more about charitable remainder trusts and many other ways to maximize the deduction you get for your charitable donations. Download our charitable giving guide from the podcast show notes at yourmoneyyourwealth.com to learn when to give, how to bunch your donations, and for more details on gifting appreciated property, qualified charitable distributions, charitable gift annuities, and the limitations on charitable deductions. Click the link in the description of today's episode in your podcast app to go to the show notes and download these steps on informed donating for free.
Go to yourmoneywealth.com, click on Ask Joe and Elle on the air, and we will answer them right here. It might take us a month, and laws will change, but we will get to them as soon as we possibly can.
And when we read the answer, by the time you hear it, the law may have changed too.
Absolutely. So
just be careful.
Yeah, this is for entertaining and purposes only.
In fact, these days, when I look up the new tax proposal, I make sure it's only a week old or sooner because it's changing that quickly.
Right. Evan writes into us and he goes, "Hey, my company has a match for donating. I'd like to take the standard deduction of $12,500. If I donate $150 and my company matches $150, can I donate $150 and write off $300? Which is the $150 of my donation as well as the $150 of my company match. So he wants to take a little credit for the company's donation
because it was because of him that they got the donation.
Doesn't the company get to write that off?
Of course, Evan. Sorry, it doesn't work that way. And this is true of all taxation, which is whatever you spend, that's your write-off. You don't get like a phantom write-off. That's the way tax basis rules. I'm not going to go into any of that because who cares? But it's the easy rule to think of is if you spend $150 in a donation, that's your deduction.
Right.
The company actually gets $150 deduction
for giving it to the charity as well.
That's right, because that was their money.
Yeah, they're not writing. The company's not writing $150 check to Evan.
The only way you would get to write off the whole 300 is if the company paid you an extra 150 personally.
Right.
That went through your salary. So that gives you tax basis to write off the 300.
But the company's giving the money directly to the charity and they're writing it off.
Of course. Yeah. So I like the idea, but no, that doesn't work at all.
So a couple other things, charity wise, people think, hey, I gave my kid $10,000.
Yeah, that's a write-off, right?
Can I write that off?
Well, it is for you, but not for the IRS.
It is the season for gifting.
Yes.
But yeah, the old Christmas gifts, you can't itemize your Christmas gifts to the kids.
Yeah, and you can give away $15,000 a year to each kid, and if you're married, you and your spouse can do $15,000, so that's $30,000. And if your child,
but there's no tax write-off there.
No, there's no tax write-off.
You just avoid the gift tax.
Yeah, that's right. If your child is married, then you can each give to the couple $30,000 each. So $60,000 would be your max in that example. Yeah, there's no tax write-off. What that does is that it doesn't count as gift taxes, so it doesn't reduce your estate tax exemption when you pass away. That's the only reason we have that $15,000 rule, but it's not a tax deduction.
Good try, Evan. I like the question. But unfortunately cannot write it off. I have an hashtag.
I think that was supposed to be a $sign.
Hashtag. All right.
870,000.
870,000. I have an hashtag $870,000. Oh, now here I go again making fun of people.
Oh yeah, that's typical.
Well, Real Life Ninja is going to be on your ass now. Come on.
No, I'm just reading what people write to us.
But then you make fun of them.
No, well, it's like, come on, proofread here. Stock portfolio. Should I hire a financial advisor to help me grow it faster? Okay. Hashtag 870. I don't know.
And the actual question was hire a financial advisor to help make it grow faster.
So
the hashtag 870.
The hashtag 870. There's a lot of things a financial advisor can grow faster.
Well,
I don't know about hashtag and 870.
What kind of investment is it?
I don't know. No, I mean, you're not going to do not hire a financial advisor to make your money grow faster, right? That's if someone is selling you that, hey, I'm a really good financial advisor and I'm going to make your money grow faster.
I can pick the right stocks.
Come on, hashtag faster. No, you're not doing that. You need a financial advisor to map out your overall financial life, to take a look at, all right, here, what are my goals? When do I want to retire? What is my tax situation? What is my other income sources? What do I have kids? Is there college? Is there debt? Is there whatever?
And they will help you not get too over anxious when the market goes down, and they will kind of try to put on the brakes if the market goes up too fast, because we want to buy when it's high and sell low, which is not a good recipe.
Right. It's not faster. It's slower. It should be boring. Investments should be boring. So no, congratulations for having hashtag 870. That's pretty impressive. And then he's got parentheses, mutual fund. Okay. Dear Big Al and Joe, I'm married to a smoking hot woman, 8 years younger than me. She's smart, kind, and talented. Did I mention she's smoking hot? Who's this guy?
Well, I would say congrats, Lucky.
I like he's just coming blazing.
Well, that's much better than saying the wife.
Yeah.
Just for you guys out there.
All right.
Or the old lady, even worse.
Yeah.
Smoking hot. All right. I would like us to retire on the same day. Oh, this guy's in love. I mean, he's just
Wants to spend every moment
every
with this smoking
every
hot
second.
woman.
Oh, with this, they do a survey for men and women, right? When people are about to retire, and they'll
Yes.
they ask women, they're like, okay, well, what's top 5 things? What do you want to do when you retire, right? And then
Right.
it's like, well, I want to take up this hobby, I want to travel, I want to do this, whatever.
Right.
And then they ask the husband or the male, what do you want to do? And then number 1 is always, I want to spend more time with my wife.
Yeah, they don't have 2, 3, 4, or 5.
Like, that's
Maybe
it's like.
play golf once a week.
Yeah, and the wife is like, wait a minute, spend more time with my husband is like,
That
it didn't even make the
it.
top 25. Get the hell out of here. You're bothering me. So just FYI, I want to retire on the same day, on the same second as my wife. Because I love her. And then I mentioned she's smoking hot. And I'm so much older than her. Oh, when I'm 70 and she's 62, she plans to take her pension at 65 and Social Security at 67. Okay, other than planning for 3 years of health care until Medicare is available, are there any other financial issues I should consider? Sincerely, Lucky in Rochester. All right, so he wants to retire on the same day to a smoking hot wife that's 62 and he's 70.
Yeah.
Okay, so he wants to take, she's going to take a pension at 65 and Social Security at 67. So I'm not sure what any other, I mean, yeah, there's hundreds of other planning.
We don't have any details.
We just, all the details we have is you got a smoking hot wife.
And when you're going to retire.
I need a financial plan. All right, give me some information. My wife is smoking hot, and I'm 10 years older than her. Okay,
Get
go.
some insurance, Lucky.
Go, spitball it.
Spitball it. Come on, give me your best.
Here's my best. Spend more time with your smoking hot wife. I do have one thing, which is this: if she doesn't need the money at age 67 for Social Security, wait till 70 because it's 8% increase each year. But that's all we have to work with.
That's it. Oh, you are lucky.
He doesn't even have to think about finances. He's focused on her.
Yeah, that's it. Retire on the same day and just love your smoking hot wife.
Right.
And,
Everything works out.
Everything works out.
What's more important than that?
Batman, Joe's attitude reform, and judgment about drinking choices in the derails at the end of the episode, so stick around. Your Money, Your Wealth is presented by Pure Financial Advisors. Click that Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 to schedule your free financial assessment at a time and date convenient for you, no matter where you are in the country. Chances are one of the experienced financial professionals at Pure will be able to identify strategies to help you create a more successful retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Good buddy Batman, he writes in, does he go to every single event that we hold?
I believe he does. Yeah, I think that is the case.
Yeah, and he still has questions.
Although I'll have to say, we had a webinar just today that we recorded, and I did not see him. So apparently he was in the Batmobile fighting crime, taking care of business.
Taking care of the criminals. That's good.
All right. I already got enough hate mail.
You've never got any, have you?
Yeah, the Ninja Joe.
Well,
I should retire.
Real life ninja, yes.
Why?
Yeah, hang this stuff up.
Doesn't provide much value to the show.
Yeah, it's a miserable person. All I do is make fun of people.
Would you work on that?
Wow, that one is really stuck with you, hasn't it?
Yes, it's
So
butterfly wings.
Changed your life.
I'm very sensitive.
The moral.
Every time I walk down this, street or in the hall in the office, I look him in the eye and say, "Hello, you look very nice today."
So the moral of the story is don't insult Joe. He remembers for years.
He didn't insult. He just kind of just laid the truth out. And then I had to come to Jesus with myself.
It was tough. Huh?
I don't want to run into Ninja Joe or whatever his name is on the street. This is now my go-to relaxation activity instead of having a cold fat tire amber ale. Would have thought.
Wow. Okay,
Man.
so that's healthy choices. Listen to Your Money, Your
Oh
Wealth.
my God, I used to drink fat tire and I got very fat tire around my belly.
You did. Huh?
God.
That's why you stick to the Coors Latte.
Coors Latte, my friend. And then now you know what I'm doing too, is I'm going with and I hate to admit this, especially on air, but little seltzer waters.
Oh, you are? Okay.
I'm not a big fan of the White Claw, but because I'm almost embarrassed to admit that I drink that stuff. But
Isn't White Claw hard cider or something?
yes, seltzer water. It's a little hard
It's still alcoholic. Why are you embarrassed to mention that?
Okay, if you see someone pouring down a White Claw, I don't know. I'm just looking at that person. I'm gonna
That's
have
like-
some judgment. I'm sorry. That's just me.
Remember the old days?
Ninja.
Wait, it reminds me of. I'm having a wine spritzer.
Yeah, it's like Bartles and James. What was that? Remember Bartles?
The wine coolers.
Wine coolers.
I mean, right? You're gonna hey. You go to a bar with the fellas, right? And then everyone's having, a paper plane, tequila on the rocks, right? And someone's getting, my buddy here's Greg is getting a fat tire. And then I'm like, can I get a little Chardonnay spritzer, please? Right?
Yeah, listen.
You can say that you're
up.
taking it to your date at your table. They don't have to know it's yours.
So now I'm drinking these little,
Yeah, but he orders two of them.
Yeah, okay.
but it's low-cal, gluten-free, Buddy mine's like, yeah, I'm on a diet. I'm going to try these. And then I'm like, okay, I'm going to try them too. Yeah.
Oh, and you like them?
Well, yeah, now they're kind of tasty.
Yeah, got it.
But then I look, it's the same calories, like Coors Light.
Yeah, might as well have that.
Yeah, I know. Now, but on the golf course, I'd like to play in the morning. And sometimes, if you crack a beer at 9 a.m., people kind of look at you funny.
Yeah, so
They're not a White Claw.
do a little spritzer. You're okay.
A little spritzer. Yeah.
It's just 7-Up. Don't mind me.
There's very little judgment.